Hi everyone, I wanted to make this video for you guys to explain a couple accounts that are going to be used often throughout our class. So I wanted to make sure you had a good understanding of these items. And these are accounts receivable and accounts payable. Now they sound similar, right? Because they both start with the word accounts and accounts, as you can see there. And they are related in that they are both involving a promise to pay cash in the future. But these accounts, even though they're related, they're different because it all depends on which side of the promise you're on. If you're the one receiving somebody else's promise that they're going to pay you, it's a receivable, meaning you're going to be receiving the money in the future. And if you are the one making the promise to pay somebody, it's an accounts payable because you're going to be paying the cash in the future. And as you see here, I'm going to be abbreviating these to AR and AP throughout the class. So when I say those abbreviations, I hope that you will recognize them. And those are common abbreviations that are used in the business world. So when you run a business someday or work for a business someday, those are terms that you're going to be hearing as well. So let's take a look at some examples of AR and AP. We're going to start first with accounts payable. And our example here says that on November 4th, the company purchased office supplies for $7,100 on credit. Now that word right there, on credit, is your clue that this is going to involve an account receivable or an account payable. Because that term on credit basically means I'm not going to pay you in cash right now. I'm going to give you a promise to pay in the future. So in this case, we've got the company over here and Office Depot over here. And in our transaction analysis, we have to look at both sides of the transaction, what's being given and what's being received. In this case, and we're accounting from the point of view of our company, the company, Office Depot is giving us office supplies, and we, our company, is giving them a promise to pay in the future. And we call that promise AP from the point of view of the company because we're going to be paying the cash in the future. So let's take a look at that from the transaction analysis with the accounting equation. So as you see here, this is the spreadsheet that we looked at. I only included the accounts that we're going to be using for this particular demonstration, just to save space on my slide. But it's set up the exact same. Date on one side, assets equals liabilities plus equity, which is the accounting equation. So what we see here is that we have supplies under assets are increasing by $7,100. And supplies qualify as an asset because, again, assets are resources owned by the company expected to yield a future benefit. And so supplies can benefit us because we can use them in the future to do the work that we need to do in order to make money. The other side of the equation is under liability. And AP falls under liability because it's a promise to pay, and to refresh your memory, liability means creditors' claims on assets or debt. We owe this money. It's our debt, so our debt is increasing. So you see here it's $7,100 on the asset side and plus $7,100 on the liability and equity side. So therefore, our accounting equation is in balance, and we've accounted for both sides of the transaction. Now let's look at accounts receivable. This transaction occurred on November 7th, and it says the company provided consulting services of $1,900. They sent a bill to the customer who will pay in 1 week. So we have the company still, and here is the customer. And if we look at what is being given and received, what the company gave is consulting services. Basically, what they gave was their knowledge and their expertise, and they used that to give advice and ideas to their customer for what the customer can do to improve their business. And as you can see here, those supplies definitely provided a future benefit because you see a bunch of paper and pens and things like that that they used in order to provide these consulting services. The customer, in exchange, is giving us a promise to pay. That's what we mean when we say sending a bill. Okay? Businesses do this all the time. They do the work first, and then they send a bill to a client. Some companies will require cash payment right away, but some will just send a bill and you pay it later. This is common in a lot of different things. This is common, for example, in your phone bill. Right? You use your phone all month long and then they send you a bill at the end. This is true of utilities, with water, with electricity. You use your water and electricity all month long and then they bill you for it, and then they usually give you a week or 2 weeks to actually pay that bill. So this is very common. And they do this with the understanding that you're going to pay. It's going to happen. It just hasn't happened just yet. So let's take a look at what that looks like from the perspective of the accounting equation. So that promise that we received when we sent the bill is essentially an agreement that, look, I've done the work and you're going to pay me for the work. That qualifies as AR. It's a promise that we're going to be receiving the money in the future. And that qualifies as an asset because they're going to pay us in the future, so that means future cash, which is in turn future benefit because we can use that cash for whatever we want. The other side of the transaction, as you see here, is revenue. Now, to refresh your memory, revenue is an increase in equity due to sale of products or services provided. And the key word that I want you to remember when you think about equity is the word earn. Okay? Now, a lot of students have trouble with this. They look at this and they go, wait a minute, we haven't gotten any cash yet. So did we really sell our services? Do we really deserve to record revenue? The answer is yes, okay? Because revenue is not dependent on cash, okay? Again, you have to look at that definition. It says due to sale of products or services provided, and the key word is earn. So the question you need to ask is, did we provide the services? And if we provided the services, then we earned that revenue. We did what we were supposed to do, and now we're going to get something in return. We haven't gotten cash in return, but we did get something else in return, and that was AR, which is a promise of future cash. Now, we call this concept the revenue recognition rule, or the revenue recognition principle. And what that says is that revenue is recognized when it is earned, which means when the products and services have been provided. And again, I've got my little graphic here showing you that cash does not mean revenue. Okay, you can still earn revenue without receiving cash immediately. We will receive it eventually. We just didn't receive it immediately, but we're still going to record the revenue. Now, again, like I said, this is an issue that students struggle with a lot, and it's understandable, right? We've been so ingrained to link cash with making money, but it's really a concept that you need to kind of separate in your mind, and also, as much as possible, focus on these definitions. The more you focus on the accounting definitions, the better you'll be able to apply it and then break apart that concept of cash with revenue. All right, now let's look at what happens though when the cash is paid or received. So now let's look at accounts payable being paid, okay? This happens now on November 10th. And it says the company pays $900 as partial payment for the office supplies purchased. Okay, now as you recall in our previous slide, we purchased $7,100 of office supplies. Now, I know that what we're paying now isn't the whole thing. It's only $900 partial payment, but we're making our way. Eventually we will pay the whole thing, but we're working on it. So what we have here, we've got the company, and now they are giving the cash to Office Depot. They're making that payment. And in exchange, Office Depot is going to cancel out our liability, our debt. They're going to say, okay, you don't owe us anymore because you paid us. So here's what that looks like in the accounting equation. So you see here on November 10th, we're paying cash, which is a negative $900. And also, our liability or debt is going down by $900. And you can see that further when you look here at the balance. Our balance is now $6,200, which is equal to the $7,100 that we started out with, that we bought from them, that we originally promised to repay, minus the $900 that we just paid. So we've been released of part of our liability. And now let's look at accounts receivable being received. It says here on November 14th, the customer paid $1,900 to pay for the consulting services they received on November 7th. And remember, they told us they were going to pay in a week? And look, they did pay us in a week. So in this case, the company is receiving the cash from the customer, and in exchange, we're going to cancel out what the customer owes us. We're going to cancel out the future benefit because we've received it. We've received that future benefit. The future benefit was cash, and now we've received it. So it's no longer future benefit of AR. It is the cash. So if you look here at the accounting equation, on November 14th, we see that we've received cash of $1,900, and our accounts receivable has gone down $1,900 because we've received it. We're not going to get it anymore. We've received it. We're essentially exchanging one asset for another. So our net effect here on the asset side is 0. And of course, we have nothing here on the liabilities and equity side, which is 0. So again, our accounting equation is in balance. 0 equals 0. Furthermore, when we look at the account balance for AR, we see here that the balance owed now is 0. They paid us. They owed us $1,900. They paid us $1,900. So now they don't owe us anything anymore. And so in that case, now we have received the cash, but it's important to note an area that sometimes what students will do is they'll think, oh, well, now we're being paid for the consulting services. Now it's time to record more services. But did we provide more services? No, we didn't. We provided those services on November 7th. So we recognized that revenue, the services we provided on November 7th when we provided it, and that has nothing to do with when we received the cash. We received the cash at a later day. So I know this topic can be a little bit confusing for students, so I hope that you will have found this video helpful. And again, it's going to help you to be able to do your homework assignments. That'll give you a little practice working with it, and then we'll get a little more practice in class where we can work on it together and answer any remaining questions that you have. All right, thanks a lot, guys. Bye.